Today we're going to talk about the paradox of P&L management, which is a series by Stephen Moye that's been on LinkedIn, which I think is excellent and highly recommend that everyone check it out. Stephen's had a long career within mortgage banking. He is currently the producing sales manager at New American Funding. And let's talk about your first part where you talked about ownership without readiness. And I thought that was so great. So talk to me about that.
Okay, so what I was talking about was a lot of times in the mortgage business, ownership is offered before infrastructure or support exists.
Yeah,
So the takeaway on that is production skill and operational readiness are not the same thing. You may
sure.
be a great producer, but that doesn't mean that you are ready to manage things. And the example that I would give you is a couple years ago, a company was offering me, actually this would have been about 7 years because it was before my current company. They were offering me what would still be considered a substantial amount of money to come over to their company and take over their P&L and do a P&L model. Now, I hadn't had a ton of experience on it, but I mean, I'm not a dumbass, but I wrote in the counter, I said that I wanted to have someone within the company that could help, that was not my direct report, to help me workshop ideas and to help manage a bit, like a training wheels kind of thing, like an advisor. And it could be anyone that they picked. I just wanted to have someone where
Mhm.
I could workshop ideas, not under the pressure of accountability. And I thought that they would, part of the reason I thought of it was I needed it, but I also thought it would be make me more impressive because I'm being like honest and stuff like that. And they said no, we don't do that. And when it came back to me from the recruiter some ways back, that it was thought of as a high maintenance request, and that told me all I need to know about it is that if you're going to offer this, but you're not going to offer support on how to manage it successfully, then why offer it at all?
Well, it's a great point, and it's one of my favorite topics. And of course, the prevalence of the P&L model is based on your production, but basically moving to another company and now doing your own team and your own thing doesn't necessarily translate into the right results. And that's the reality of it. And so, were you surprised when they thought you were a high maintenance? I'm just curious.
Yeah, I thought it was, but I mean, the reality is production skill and readiness operationally are not the same thing.
Right.
Because closing loans teaches you how to win business, but running the P&L teaches you how to not to lose it.
Yeah.
So, like, why wouldn't, if you're investing the amount of money, to bring on people, both not even just like in terms of transition money and all of that, but
Sure.
rental space and stuff like that. I don't see why companies don't recruit on that. Like, why don't they give that consideration when they're putting together a package in terms of that? But in my darkest hour, I think that if you were to get a lot of these large leaders and get them, in cigars and brandy in the smoke-filled rooms, and you were to ask them, a lot of them, the only reason they're offering it to a good proportion of their recruits is because they don't want to be the company that's not offering it and lose it to somebody who's offering it, even if that person's not ready.
Well, that's another topic that we can do another podcast on. So, because is that when you think about it, and my last comment would be that senior leadership really kind of didn't to really rethink all of this because does that work anymore? I mean, in other words, can we have people being recruited on basically a margin and you're responsible for everything else as a salesperson. And so that's why you have this issue that we just talked about. You can't bring young people in to the business because in essence, you can't pay for the cost because the pricing's being outsourced to the loan officer. So it's another story unto itself. I just don't see how that model's not going to bring in a new generation. And I see it in training
No,
class.
they're going to be call centers.
Yeah.
If you want to be, you have to go through a call center, and that's not a bad thing. But there's this hierarchy, like there's this purity of leads. A lot of times, if you talk to companies that they think about uh, this golden age where the loan officer would get leads from realtors, but first time home buyers, second generation immigrants,
Yeah.
first generation, they're going to the internet first. And so we romanticize where leads used to come from, but we still have to go where leads are now.
Correct.
And that's why consumer direct and call centers are doing well, but a lot of companies will disparage someone from a consumer direct background. And yeah, I don't think that's fair. Like I remember when Better was having some trouble and a lot of companies were
Mhm.
recruiting, you would see some of these names where they did like 400 loans a year and 80 million in production, and he'd be like, disparage it. I'm like, if you do 400 of anything, there's probably things you're pretty good at. Maybe it's time management, maybe it's product knowledge, maybe it's just knowing how to do that. But it's not, you can't devalue it.
Yeah. Well, like I said, it's a topic unto itself because what you really are saying is that you need to bring in a new generation, and you're not going to bring it under the model of you better already understand, how you already need basically a portfolio of loans already.
Yeah, and the fact is that the demographics of the average loan
Yeah.
officer is white, male, and middle aged. But first time home buyers, single women,
Yeah. Right.
single men need to put a deed on it. You need to have, their first and second generation immigrants. And our sales thing doesn't match where the
Right.
buyers are coming from. And we're not thinking in terms of that reality. And
Yeah.
so we chase licenses instead of like coaching people up.
No, well, that's like I said, that's one of my favorite topics. That's for sure. I do write on that a lot in LinkedIn. But let's talk about your part two. You went on discussing ownership without perspective. Talk about what that means.
Okay, so if you follow the LinkedIn mortgage world, you'll find that a lot of loan officers' understanding of kind of the whole ecosystem is similar to a blind person describing an elephant by pulling on its tail.
Correct.
And the thing is that ownership is the moment where the whole elephant shows up. Because ownership, any type of ownership requires understanding of operations, capital markets, servicing, compliance, staffing, risk, and cash flow. And ownership is not a promotion, it's a trade. And it's a trade-off. And so a lot of times, if you're doing if you're good at originating and stuff, why not be great at that? Do you want to
Yeah.
spend 20 or 30% of your time doing something that you don't necessarily like and may not be
Good at.
good at? And and I think that we discount, but part of that is that we have this whole title inflation issue in our industry anyway. Like, when I'll be honest, so I was a branch manager at my previous company, and so I'd been a branch manager at First Cal, and then when I went to my next company, I went I was no longer manager in my title, and it affected my business how people viewed me in some ways. So when I became branch manager at the company before New American Funding, the one of the deals that I had was I don't care what the title is. It can't look like it's a step down. Now I was arriving with a small team, but the thing was is that I knew that to certain people title matters, but now you have all these inflated titles, and you can
Yeah.
be in the business. When my first business card when I was in the business for 1 week said senior loan officer, and I this comes down to a point, and it's not in the article, but it's one of the things. This is the only industry where the loan officer has a fiduciary obligation, where having 20 years in the mortgage industry matters less than what the rate is. Like if you need a trust attorney, you're likely going to find more value at someone who's been a trust attorney for 25 years than somebody who's just graduated law school and been in the business for 6 months. If you're needing a financial planner, you're probably wanting, see the value in somebody who's been doing this for 25 years rather than someone who just got their license. In fact, there's some securities you can't even sell after a
Correct.
certain while. And if you're a CPA, obviously, if you need a tax attorney, you're going to maybe find some value in someone who's been doing it for 25 years over someone who just, got licensed. We're the only industry where so little is paid towards that. And the consumers don't see value to that. I lost a deal this week. I was giving a better deal to the client. I had solved a bunch of problems, and it was an online lender. The guy had botched up the application, was creating a lot of drama for the
Mhm.
seller, and yet he still stayed with them. And my NMLS license has 6 numbers in it, and this loan officer, because I checked the LE, has 9 digits in there. But he saw no difference in there. And I realized, when he decided to go elsewhere, that I failed because I create an environment where he saw the value of my experience and lack of drama.
But isn't that also an industry problem? Because, in other words, when you look at the data shows that only 20% of the consumer, it's actually even less than that, go back to the original loan officer. And so then you go and you say, well, how can you make money in that scenario? Because reality is the customers aren't coming back to the original loan officers. And when you overlap the 50% of the loan officers are underperforming, maybe what the problem you're up against is that the consumer now is so used to bad service that at the financial sector, because of the quality of the salesperson, that they lump everybody together. Well, what's the difference between you and me? I mean, that's what you're up against, because we've tolerated so many underperforming loan officers, and they don't go back. The consumer does not go back to the original loan officer.
I
80% of them
agree with
walk
that,
away.
but part of the reason they don't go back is that database management is a huge blind spot of loan officers. But the other side of the coin is, if I don't know if you notice this, but a lot of the big mergers and acquisitions in our industry are referring to servicing, basically servicing. And so a lot of people that are, working for correspondent lenders or companies that don't have servicing, basically they're renting their database. So, and the likelihood of them being able to even if they gave great service, the aggregator that's doing the servicing is going to be very aggressive because you don't want
Mhm,
portfolio runoff. And so
mhm.
basically, even though loan officers are taught never lose a client, no matter what you do, because loan officers got to get paid, it's hard to make the margins small enough so that you can. So with I've had clients where we were competing against the people we transferred the servicing to, and they wanted to go with me, but we couldn't make the margins work, and I understand that reality, and but I think that's part of it. But a lot of
That
times,
doesn't explain the 80% that go away to somebody else. I mean, in other words, what I would say, and this is part of service levels today in all industries, is that good service is so rare that you just assume you're going to get bad service. So, from a customer standpoint, the valuing, let's say if you're delivering great service, it sounded like you did a lot of things for that particular customer. But at the end, you're up against that, well, gee, you know,
and the reason I lost it is the particular realtor was with a realtor where they had a using this, like there was an incentive to
mhm,
use that
yeah,
agent, and the
correct.
the the agent was representing both sides of the deal and had a vested interest. That's what it
Right.
came down to, and
Mhm,
that's reality. But it is troublesome. It would suit the industry to be able to be more professional,
correct.
and that and maybe we have, like, you have the whole certified mortgage professional, like, like we were going to try and, the way that you solve any problem is to add initials to the signature. But you don't have, that never took hold, because I know people who have that distinction who are not particularly good loan officers. Even, but it would be nice to see it more professional, but it's not always in the vested interest, because then do you have to pay comp is obviously going to be an issue because of margin compression, but also I imagine, CFPB is probably worth a look see, and I do think that flexibility on comp so that I don't lose a good customer because I can't match an online lender that's has one loan officer and 10 AI bots handling
Mhm.
things. It would be nice to be where I have more flexibility on what I can charge for a previous client.
Yeah. Well, so let's move into the third article that you wrote, the third post on the ownership without leverage as
Yes.
part of the P&L model. What did that mean from your viewpoint?
Okay, so I'm talking about how leadership economics have changed. So one of
Sure.
the challenges is that so we have a huge amount of recruiting out there, and if you're on the LinkedIn blogosphere, you'll hear people complaining about loan officer comp. Now we're past the silly season where people that did 8 loans a year were getting $100,000
Sure.
signing bonuses, and I will preface this by saying I've never taken a signing bonus, and I have never, and I'm not against anyone taking a signing bonus, but
Hmm.
I never have. And but I do think that the leadership economics have changed because the amount of recruitable loan officers has diminished. So in October of 2022, I was part of a meeting where at our company we were going in the region on the number of recruitable loan officers, meaning people that met,
Correct.
and that would be 18 to 24 units a year. That was if you did that, that was minimum loan standards, or I don't know what initials we were using, but you get the point. There was 150 in a area that was the size of New Jersey.
Hmm.
And now out of that, you have to take out 40% immediately because they're either so large that you're never going to get them, or they're running broker shops and things like that where it's not going to make sense. And so you have a smaller, the amount of recruitable talent is so much
Correct.
smaller that basically when a company is recruiting, they're not, it's more like they're recruiting like you would recruit a partner for a law firm. So if somebody's like recruiting, I'm a top 1%. If someone's recruiting me, it's it's not like I'm going to work for them. Like I'm going to have some say on my destiny and stuff like that.
Mhm.
And so, but because of that, companies will rather pay for production rather than developing new originators. And so the takeaway is leadership in mortgage is often described as leverage, but for many producers, it functions more like a trade because I'm trading off my time and running the P&L. And then, but the other challenge, like, so I will get a lot of people who call me and say, "Hey, come and work, build a team." But the amount of people that I could get, so I'm not going to get a $2 million a month producer
Mhm.
because they have options here.
Correct.
And you don't have to do that many loans in Southern California to do 2 million a month. But they're not good. They have their own options. They can go control it. So if I do take on a team, I'm going to be taking on people that are seventh round draft picks, like people that
Correct.
haven't it hasn't worked for that. Now, for me to go and with standard override, and let's be generous and say, 20%, which is high in most places. It's 10 to 15, but let's say it's 20. I have to raise a ragtag team of loan officers to do 4 million a month to make what I would make on by doing another loan.
Mhm.
And like I like coaching people up, I like that, but not at the expense of production, especially like I had a team, and then a couple of two of them left the business, one became a coach, the other one got silly money. And I don't blame him for that. He's now back working with our company, so that tells you how that goes. But the thing is that you have the silly money, and it's just
So I think what you're saying is that it doesn't behoove you to coach someone up because the reality of it is that you can make more money on your own production, and even if you're able to be successful, that coaching people up, you're in essence your override's not enough to redirect your time. I think that's what you're saying,
that's exactly what I'm saying, and I
and
appreciate
I
you.
think it's right, it's true.
And it sucks though because
It does suck.
it's
Well,
short
that's why we
sighted.
That's why we don't get younger people coming in. There's no real incentive under the producing manager model that it's a P&L model because why, the person, why are they worrying about that? Why are they spending their
And
time?
what I was going to say was, when the meltdown happened, I had people leave my team, and I could have built a team, but at that point, my production was more valuable to
Right.
our region
Mm.
and towards keeping. Uh, we only had to lay off like a part-time employee during that because my manager runs a really good P&L, and that's the other thing, like with companies, like it's really underrated. Like people don't think, oh, he's inspirational or whatever. You know what's inspirational to me? When I know that my manager runs a clean and fair and profitable P&L, and stuff gets done because now I can sleep at night and I'm not worried about it.
Mhm.
That's underrated.
Well, that's part of under the global picture. Is that model going to work going forward? And I make the argument that we have a McDonald's kind of approach, but we don't have any rules on how the hamburger gets made.
Right. We're
Yeah.
not so much a mortgage company with great technology. We happen to be a technology company that happens
Yeah.
to do mortgage.
True.
So I do
So,
think AI is going to expand that more because it's more
yeah,
profitable to give a good producer, the tools on AI and stuff. I average 5 to 6 loans in a month with just one team member, and I know that with technology already, I'm seeing that I'm doing more. I'm able to do more loans and have more time,
sure.
and so it's cheaper for the company to invest in that than it is to invest in people that you have to coach up.
Well, but the problem is when your average age is early 50s, that at some point you're going to have to replace them, and I don't think AI is going to replace all of them. So you're going to have some staff component to it, and that's the age-old question. Well, we covered a lot today, and I think it's all fascinating from your perspective because you're obviously been a top producer a long time. Any other comments that you'd like, any other takeaways you'd like to share today?
So I've got a couple. So the point of my Paradox series, and if you follow me on LinkedIn, there's a whole bunch of them about just
Mhm.
hear what I say about recruiting. I cover a bunch of topics, but the point of the Paradox series was not to criticize the industry. I love the industry, but it's to provide clarity and to put a name on something that, from my heard from my DMs and comments, people have recognized it once I put a phrase to it. And then my hope is that once people kind of put a name to this, we can start designing better systems. Because production skill and operational readiness are not the same.
That is for sure. Well, I'm thrilled to talk to you today because I agree with you 100%. So, how can people get a hold of you or if they want to
I'm on
talk to you more
LinkedIn.
about? Okay,
I'm on LinkedIn. LinkedIn is great. I don't really do much other social media. You can always call me at 619-895-8128. LinkedIn, I'm pretty easy to find, and I'm usually posting. And unless if you sell crypto, if you're a asking me for my Snapchat, no. But most people I'll accept, and I'm glad to do that.
well, I highly recommend our listeners today to follow and connect with Stephen. I love his posts. He's been doing great ones. This series is another example of them. And certainly, like many of us in our industry, we're just really trying to give, insights from different parts of our industry. Like, what do we need to do to get to that next step? So, anything else, Stephen, that you'd like to share?
Yes, everyone should read Mortgage Manager Mastery. It was a phenomenal book, and
Uh,
I'm on this sixth chapter already.
okay.
It's a very
Yes,
it's a very good read, and I absolutely appreciate it. And I also appreciate you speaking out in the industry that you and I both love so much.
sure.
You can only I don't think you or I come at this angle if we didn't care and see the value of what we do and how much that we love it and the
Yes.
opportunities that the privilege that we get to be able to help families and
Mm.
achieve their is something that never gets lost on me, and I
Yeah.
get the same from you.
Well, I agree with you 100%. It's a fabulous industry for sure. And was so lucky to fall into it, I'm sure, just like you did. So I want our listeners to, if you would like to hear more from the podcast. Every Monday, we issue another one with different conversations with different folks within our business. And also certainly connect with us by going to patsherlock.com. Thanks a lot, Stephen.
Thank you so much.
Check out my new book, Mortgage Manager Mastery, where 23 mortgage sales leaders shared their best practice in managing sales staff. The book is available on Amazon and Kindle or paperback.